All right, get ready, because today we're going deep, really deep into the mind of, well, one of the greatest investors ever, Warren Buffett.
Yeah.
Okay, so let's jump right in. Buffett's first rule, it's so simple, but it's powerful. He says, rule no 1 is never lose money. Rule no 2 is never forget rule number 1. So why is this like the core of his whole approach?
Well, you got to understand, in investing, it's not just about scoring points. It's about not getting taken down. Defense is just as important as offense.
Most people, they're all about, how much they can make. But Buffett, he's different. He's all about minimizing the risk, the downside.
Yeah, imagine you spend years, you're carefully building your wealth, right?
Yeah.
Growing that portfolio, but one bad decision, one miscalculated risk, and poof, it's all gone.
Like that game Jenga. You carefully pull out the blocks, you build higher and higher, but one wrong move, and bam, the whole tower crashes down.
And that's why Buffett, he's all about discipline and like really understanding what you're putting your money into. He doesn't just swing at every pitch,
Okay, and speaking of pitches, his second tip uses this really cool baseball analogy. He says, opportunities come infrequently. When it rains gold, put out the bucket, not the thimble.
This is about being ready. When you've done your research and that golden opportunity pops up, you got to grab it.
And it's not just about, the money being ready. It's about, like, your mind being ready, too, right?
Yeah, totally. If you hesitate, if you second guess or try to time the market perfectly, you'll miss out. That's the thimble mentality.
So how do we get that bucket mindset? Like, how do we prepare for those moments when it starts raining gold?
It starts with knowing what you want to achieve with your investments, understanding how much risk you can handle, and doing your due diligence.
And I think maybe just as important, it's about trusting your gut. Like, when you see an opportunity and it fits your strategy, don't be afraid to jump on it.
Think about how Buffett did it. Like when he bought See's Candies back in '72, he saw a company, a strong brand, loyal customers, and, room to grow.
He didn't wait for a better price.
Yeah.
He saw the value, and he went for it.
And it's been a huge win for Berkshire Hathaway, See's Candies. It's been a steady performer, great returns year after year.
Okay, let's move on to tip number 3, and this one might surprise you. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price.
A lot of investors, they get caught up chasing those bargains, trying to pinch pennies. But Buffett, he focuses on the quality of what you're buying.
He's saying, don't compromise on quality just to save a buck or two.
Exactly. A fair company at a discount, it might seem like a steal, but in the long run, its potential might be limited. A wonderful company, even if it costs a bit more, offers more value over time.
It's like, think about buying a car. You could get a used clunker for cheap, but it might break down all the time and end up costing you more in repairs.
Right. Or you could invest in a car, maybe a bit more expensive up front, but it's reliable. It'll run well for years.
It's about looking past the initial price and thinking about the value over time.
Look at one of Buffett's most famous investments, Coca-Cola, late 1980s. He buys a big chunk of the company, even though some people thought it was overpriced at the time.
So what did he see that everyone else missed?
He saw the power of that Coca-Cola brand, its global reach, how it consistently made money. He was betting on a great company with a lot of room to grow.
And that bet, well, it paid off big time. Coca-Cola, it's still a core part of Berkshire Hathaway's portfolio, made billions in returns.
So next time you're looking at an investment, remember, don't just chase the cheapest thing. Look for quality and something with long-term potential.
Okay, ready for tip number 4. This one's about, patience and choosing carefully. He says, the stock market is a no-called strike game. You don't have to swing at everything, you can wait for your pitch.
Buffett's saying, be picky. You don't got to buy every hot stock or follow every trend.
Stay disciplined. Wait for those opportunities that really fit your investment strategy.
Imagine you're at bat right. You wouldn't swing at every single pitch. You wait for that perfect one, the one you can knock out of the park.
And this goes back to his first rule. Don't lose money. By being choosy, waiting for the right pitch, you're less likely to strike out.
And sometimes the best thing to do is not swing at all. Staying out of the game, holding on to your money can be just as good as making a new investment.
Look at how he invested in Apple. For years, he avoided tech stocks. He said they were outside his area of expertise.
But then, 2016, he starts buying Apple. He sees the strong brand, loyal customers, those innovative products.
He waited for the right moment. And when it came, he went all in.
And that decision, well, it's been a home run for Berkshire Hathaway. Apple's one of his biggest holdings now.
So the lesson here is, Don't feel like you got to invest in something just because everyone else is. Do your research, wait for the right time, and don't be afraid to sit on the sidelines if nothing looks good.
Buffett's all about the long game, not those quick wins.
Okay, on to tip number 5. And this one is classic Buffett. We simply attempt to be fearful when others are greedy and to be greedy only when others are fearful. So how does this contrarian approach actually work in the market?
This is all about the psychology of investing. When markets are up and everyone's feeling good, it's easy to get swept up in the excitement.
It's like, FOMO, the fear of missing out. People start making impulsive decisions.
Exactly, and that's when Buffett gets cautious. He knows that too much excitement can lead to things being overpriced, more risk.
So when everyone's greedy, he's looking for the exits.
Not always. He's carefully looking at whether the market is really reflecting the true value of things.
And then the opposite. When markets are crashing, everyone's panicking. That's when he sees opportunity.
Right. When fear takes over, prices can drop lower than they should, creates chances to buy for those who've done their homework and aren't afraid to go against the crowd.
So it's all about staying calm, not getting caught up in the emotional roller coaster of the market.
That's Buffett's contrarian approach, having the discipline to think for yourself, act rationally, even when everyone else is doing the opposite.
It's like that saying, buy low, sell high. But it's harder to do than to say, isn't it?
Definitely. It takes courage to go against the flow, to buy when everyone's selling, sell when everyone's buying.
But that's where the real wins are. According to Buffett, by being contrarian, you can take advantage of market inefficiencies, make some serious returns.
Remember the 2008 financial crisis? A lot of investors were freaking out, but Buffett, he was busy making deals, buying up undervalued stuff.
He saw opportunity in the chaos. Because he wasn't driven by fear, he was looking at the real value.
And that's a key takeaway. Don't let emotions control your decisions. Do your research, stay disciplined, be ready to act when everyone else is frozen.
So, to sum it up, be greedy when others are fearful, but only if your research backs it up. Don't just blindly follow the crowd.
Exactly. Think for yourself. Let logic, not emotions, guide your investments.
We've covered a lot. 5 simple but powerful principles that have driven Warren Buffett's success.
And what's really cool is how these ideas apply to more than just investing. They give you insights into decision-making, risk management, navigating uncertainty in all parts of life.
Okay, so we've gone through these 5 key principles from Warren Buffett about investing.
And what's amazing is how they all fit together. It's not just about money. It's a way of thinking about risk, about opportunity, about value.
It's like having a mental model for making better decisions, right?
Yeah, exactly. Let's step back and look at how these principles work, as a whole.
So first, we have that foundation. Rule no 1 is never lose money, which is all about, managing risk, protecting what you've got.
It's about avoiding those huge losses, the ones that can set you back for years, even if it means, missing out on some potential gains along the way.
Then there's that bucket idea. When you see a good opportunity, be ready to act, but only after you've done your research.
It's finding that balance, patience, and knowing when to jump. You're not chasing every hot trend, but when you see something that fits your plan, you grab it.
And this connects to Buffett's idea of focusing on quality, right? It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price.
He's reminding us, the cheapest thing isn't always the best. Sometimes it's worth paying a bit more for something high quality, a company that has a real edge and can keep growing.
It's like buying a house. You could go for the cheapest one you can find, but it might need a ton of work, end up costing you more in the long run.
Yeah, or you could invest in a house that's, well built, even if it costs a little more upfront. But it'll be solid, it'll last.
It's about looking past the price tag and seeing the long-term value, what you're really getting.
And then there's that baseball analogy, right? The stock market is a no-called strike game. You don't have to swing at everything, wait for the right pitch. This is about knowing what you're good at, your style, and staying in your lane.
And lastly, we have that contrarian approach. Be fearful when others are greedy, and greedy only when others are fearful.
This is about, how people's emotions affect the market. When everyone's excited or scared, it can mess with prices, create chances for those who stay rational.
What's interesting is how these principles apply to more than just money, right? To other parts of life.
Absolutely. Like, take that idea of minimizing losses. How does that apply to how we manage our time, for example?
We can ask ourselves, are we spending time on things that really matter, things that get us closer to our goals? Or are we wasting time on things that drain our energy, don't bring us joy.
It's about, really thinking about how we use our time because it's our most valuable resource.
And that principle of waiting for your pitch, that could apply to like career decisions. We don't have to take the first job offer that comes along.
We can, be choosy, think about our skills, what we're passionate about, wait for that right opportunity, the one that really fits what we want.
And what about Buffett's idea of focusing on quality? That could apply to like our relationships. Right?
Definitely. Are we investing our time, our energy in relationships that are, supportive, enriching, that bring out the best in us? Or are we, settling for relationships that drain us, hold us back?
It's about recognizing that, we deserve to be around people who lift us up, inspire us to grow.
And that contrarian approach, that can apply to just making decisions in general. When everyone's rushing to follow the latest trend, it's good to stop, ask yourself, is this really right for me?
It's about thinking for yourself, questioning the conventional wisdom, making decisions based on your own values, what you want to achieve.
Buffett's principles, they encourage us to be, deliberate, thoughtful, and to always be learning, always growing.
They remind us that success, whether it's investing or in life, it's not about, luck or shortcuts.
It's about having a solid plan, knowing how to manage risk, and taking advantage of opportunities when they come along.
And as we wrap up this part of our deep dive, we want to leave you with this question. How can you apply these principles to your own life?
What areas of your life could benefit from a more, disciplined, long-term approach?
What are some of those buckets you need to get ready for those moments when it starts raining gold?
And what are some areas where, you might need to be more contrarian, go against the grain, forge your own path?
These are, questions worth thinking about because as Warren Buffett has shown us, the principles of good investing, they can be used to create value in all parts of life. Okay, so we've been talking about Warren Buffett, his investing wisdom, and it's pretty clear that his ideas, they go way beyond just Wall Street,
Yeah, they're like a set of tools for making smarter decisions, not just about money, but in all parts of life.
And to really see how these principles work, let's look at one of Buffett's most famous investments, Coca-Cola.
Yeah, it's a perfect example of how he combines research, patience, and that contrarian thinking.
He bought a big chunk of Coca-Cola back in '88, spent over $1 billion to get like 6.2% of the company.
And, at the time, some analysts, they were scratching their heads. They thought Coke was overpriced, that its growth was limited.
But Buffett, he saw something else. He saw the power of that brand, how it's known everywhere, and how it consistently made money.
He didn't get caught up in those short-term market swings or what other people were saying. He did his research. He believed in the long-term value.
And this goes back to his principle, right? It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price.
Right. He was willing to pay a bit more for quality for a company with a real competitive edge.
And he was also, going against the grain, being contrarian. While others were doubtful, he saw an opportunity.
He understood that the market sometimes is driven by emotion, not logic, and that fear and greed, they can really distort prices.
So what did Buffett see in Coca-Cola that others missed?
He saw the power of, habits. People all over the world, they love their Coke. It was a daily thing, and that wasn't likely to change.
He also saw, the potential for growth. Coca-Cola was already global, but there were still so many markets to tap into.
And he was impressed with the management team. He thought they were competent, focused on the long term.
So he bought in, and, the rest is history, as they say.
Coca-Cola, it's been a fantastic investment for Berkshire Hathaway, generated billions in dividends. And the stock price, it's gone way up.
It shows, Buffett's ability to find those undervalued assets, to see value where others don't.
And it reminds us that being patient, having that long-term view, can really pay off.
So what are the key takeaways from Buffett's Coca-Cola investment?
Well, first, it shows how important research is. Don't just follow the crowd or those headlines. Dig deeper, understand the business, look at its long-term potential.
Just second, be patient. Don't expect to get rich quick. Great investments, they take time.
And third, don't be afraid to be contrarian. If you've done your research and you believe in something, don't let other people's opinions sway you.
Think for yourself. Trust your gut. Be willing to go against the flow.
And, as we wrap up this deep dive into Warren Buffett's wisdom, we want to leave you with this.
His principles, they're not just about, making money. They're about making better choices, managing risk, creating real value in every part of your life.